Hello, everyone, and welcome to today's webinar on debt management. I will be your presenter. My name is David Linsky. I'm the president of Debt Free Living. We are a financial planning firm that specializes in helping people get out of debt in the most efficient manner, as well as avoid going into debt during critical times like we're in now. We're going to talk about the Your Family Bank concept today. It's not a brick and mortar bank. It's a concept we use to show individuals how to either eliminate debt in the most efficient manner or how to build up their own bank so they don't have to go into debt during tough times. I'm going to start by asking two questions. I want everyone to think about these answers. You can say them out loud or keep them in your head. But are you 100% sure you're going to have a great retirement, or do you have some doubts? Did you have doubts even before this crisis happened? Now, if we could show you how to get out of all of your debt, including your mortgage, in about 9 years without spending any additional money than you're currently spending now, would you allow us to show you how we could do that? Now, of course, the answer is probably yes. We're just going to go through, according to the U.S. Census Bureau, how the average American uses $1 of income. We're working hard for this money. Let's see where it actually goes. Right off the bat, 40% is going to go to taxes. Now that includes going through tolls, hotel tax, everything you can think of, we're being taxed on. 34% is going to paying debt each and every month. That leaves 23% of our money left for our lifestyle and 3% for our savings. The average American debt is $250,000. Now what we do is we analyze these numbers. We look for inefficiencies where the money's already being spent, and we use those inefficiencies to redirect for growth. So our average client is able to save 10% on taxes, use their money more effectively. So in the first year, they'll pay off a third of their debt. Now their lifestyle increases by 10% and their savings 12% organically. The person on the left and the person on the right are making the same money. They're not getting a bonus. They're just understanding how to use each dollar as effectively as possible. We're going to go through the 7 steps. Step 1, knowledge. Knowledge only becomes power when we put it to use. Now we're going to pull up this list, and everyone watching at home, read through it. If there's 1, 2, 3, even all the things on this list that if we could do for you would change your life, which would be the top? Reduce the volume of interest we're paying to lenders. Getting out of debt, including our mortgages, in 9 years or less. Improving our cash flow while decreasing our taxes. Saving properly for college. And down the road, not only will we do all those things outlined above, but retire with tax-favored income. I'm sure most of us have played this game before, the game of life. Unfortunately, whether we realize it or not, we continue to play this game even into our adult lives. Here's how we look at it. We all start off with a clean slate, maybe 17, 18 years old. We get a little sense of freedom. So what do? We take out a credit card. We just got a little bit of debt. But now we need even more freedom. So we get an auto loan. Even more debt. Now we go to college, or your kids go to college, and that even adds up to more debt. And then the great idea happens. We graduate college. So what do? We upgrade the car and we upgrade that debt. Now, this is going to be possibly the most exciting purchase of most people's lives. Also, the biggest debt most people will incur in their life. They get the mortgage, the house. Now they want to go on vacation, they put it on a credit card. They go around this game 2 or 3 times, and unfortunately, that's life. All we do is we try to show our clients the way to play this game more advantageously to themselves. Understand their debt, understand how to pay it off, and once they pay it off, we look at that word life, and we think about it as living interest-free every day. Don't just eliminate the debt we're in now. Make sure we have a plan in place not to have to go back into debt in the future. Some more numbers for us from the U.S. Census Bureau. The average American will have $2 million that comes through their hands in their lifetime. Seems like a lot of money. When they retire, the average person has $60,000 saved up. Now, that's definitely not the American dream. Understanding cash flow. That's our step 2. Because when we can track our money, you can control it. I'm one of those people that before will go to the ATM. I'm not sure if anyone else is like this. Take out $200 on Monday, and by Friday, all I know is I have $0 in my wallet, but I don't know where it went. Understanding where our money's going is as important as having it. We use a very simple data gathering form. Now, we don't really use this spending planner unless we need to, but we want to understand where's your money going towards your debt and savings. If we could show you a more efficient way to do it without changing the amount of dollars leaving your account each month to help you eliminate that debt in a significantly shorter time, then we reached our goal. In times like this 80-20 rule could not be more relevant. We use what's called the 80-20 rule, the plan for the unexpected and the expected. Our planning uses 80% to accomplish a goal, eliminate debt, save up to finance a new car ourselves. Whatever it is, 80% is working towards it. Now, although the other 20% is still in the same vehicles, we set it aside in the illustration to show you, in case of emergency or emotional decisions like we're in right now, access that 20%. It's not going to affect our plan for that 80% to pay the debt off or whatever we're trying to accomplish. It's there for you. It's a savings within our savings. We're going to go through now how the banks actually work. Before I do that, just think to yourself, do you know what actually happens when you put money into the bank? What that bank's actually doing with your money? Legally, that bank's allowed to lend your dollar out 7 times. So let's go through an example. We go to a bank, we put $10,000 in an account. If we're lucky, that bank will give us 1%. We walk back into that same bank, the same branch, the next day. We want to borrow $10,000. They're giving us 1% on our $10,000, but they're going to end up charging us based off our credit score these various rates. So they're giving us 1% on the same amount of dollars that we're trying to borrow, but they're charging us those rates. Something doesn't seem to be fair. What we do is we show you how to firstly eliminate your debt and then build up your metaphorical bank so you can finance things yourself. If you want to pay someone 17% interest to get some furniture, that person might as well be yourself. Step 3, minimizing debt while at the same time creating additional wealth. To demonstrate step 3, we're going to go through a real life example. Now, Mark and Joyce are real clients, but I assure you, those are not the real pictures. Their situation: Mark's 37, Joyce is 35. They have good income coming in between both of them. They have 3 children, 3, 4, and 8. And their main areas of interest, like I asked everyone earlier, were to increase retirement income, reduce their debt, get spending under control, start planning for college, while increase savings. Basically everything everyone wants to do. Now, when we go through Mark and Joyce's situation, I want everyone to think, am I similar, better off, worse off than Mark and Joyce? Whether you're older or younger, all the principles will still apply to you, but think about your own situation as we walk through Mark and Joyce. So currently, Mark and Joyce have a Bank of America account where they're putting in $25 a month, earning barely any interest, with $6,000 total in there. They're funding their 401k like everyone's told to do. They have $36,500 in there, putting in that $300 a month. Now we get the truth of Mark and Joyce's financial situation, their debt. And stay with me for this because it starts to tell a story. They get that Visa credit card, 12% interest, low balance, low monthly payment. Their medical and dental is 0%, but they're still making that payment every single month. That's money that's leaving their pocket to go to someone else's. Now their next credit card, we see their interest rate goes up a little bit, their balance goes way up, and so does their monthly payment. Now this is a horror story, their furniture. They're paying 18%, but when they bought the furniture, like we all see, Memorial Day sale, come down, get 0% APR. When you don't read the fine print, you don't notice that runs out rather quickly. Now they're paying 18% interest on their furniture. Their credit gets dinged up. They can only get an auto loan at 8%, mortgage at 6.5%. They can't refinance again because their credit score is banged up from all the other debt that they have. When we look at it, it's an average of 10% interest. They think they owe $180,000 in principal. Mark and Joyce is spending $2,177 a month to satisfy their debt. Now again, Mark and Joyce think they owe $180,198. That's their principal. Unfortunately, after they gave us their information, we were able to run them a no-cost report and to show them that even though their balance is $180,000, when we add in interest over the next 30 years, for 30 years they're going to be paying on that debt, they'll end up paying almost $200,000 additionally just in interest. They're going to pay more in interest if they keep doing exactly what they're doing than they actually borrowed out in principal. The reason this happens is because lenders know consumers. They understand consumer habits and they take advantage of our predictable nature. Paying more in interest than you borrowed out should never happen. But when they give us these repayment plans, they know exactly what they're doing. Currently, the retirement plan has them putting away $300 a month, growing at 5% rate. Let's assume they'll be in a 25% tax bracket when they retire. And in 30 years, when they finally retire, still have $306,000 after tax. That's two people with $306,000. They just finally paid off their debt. I'm not sure about you, but I don't know if that's going to be enough money to live on in retirement, especially in 30 years. So what did we do for Mark and Joyce? We gave them a simple data gathering form, which I can email to each and every one of you. We analyzed how we can look for inefficiencies in how they're paying their debt now. And what we were able to do is show them how to redirect those inefficient funds to build it up and pay off their debt. Every time we pay off a debt, we tell them redirect that payment, but now start saving it as a deposit. Before it was a bill payment, now that it's paid off, it becomes a savings deposit. Every time we pay one off, we're saving it. 7.8 years, Mark and Joyce pay off their mortgage. Now, along the way, each and every year, they're paying debt off. So they're getting closer and closer. But in 7.8 years, they're completely debt-free. Before, it was 30. By paying that debt off in 7.8 years, not 30 years, they'll save over $122,000 of scheduled interest payments. That's $122,739 that's staying in their pocket, not going to their lenders. Now remember, Mark and Joyce would have been paying on that debt for 30 years. They would have been spending $2,177 per month just to pay that debt. So if they kept making those payments, but as deposits for growth for the same amount of time, instead of just getting out of debt in 30 years, they're out in 7.8. They save over $122,000 of scheduled interest, and they'll have $1,004,387 saved up for retirement by using the same dollars that before were just going towards debt. So their current plan, be in debt for 30 years and have $306,000 for retirement. Our plan, out of debt in 7.8 years, have over $1 million saved for retirement. So this is pretty cool. Let's look at the cost for Mark and Joyce to not use the family bank concept. The math does not lie. Our way, they're going to have $1,004,387 in retirement. They're also saving $120,739 in scheduled interest. When we net out that $306,668 from their current plan, they would lose $820,458 in opportunity cost if they just kept doing what they're doing. Step 4, taxes. The less you pay, the more you keep. Pretty simple. Especially in times like we're in right now, where the government is using so much money to help stimulate our economy. Think to yourself, do you think taxes in the next 10 years are going to be higher, lower, or the same? If we really think about it, it has to go higher. Looking at history, looking at what's going on right now, taxes will most likely be higher. So if we think taxes are going to be higher, does postponing our taxes really make sense? When should we start tax planning? Probably now. To illustrate, let's do a little proposal. Since you can't physically respond to me, I'm going to pause a little bit between each situation. But whoever's listening, we're going to go into business together, me and you. But here's the stipulation. You front all the money. You're going to take all the risk. You manage the business on a day-to-day basis. And 30 years from now, I'm going to come to you and tell you how much money you owe me. Would you want to go in business with me? I'm hoping everyone is screaming out loud, no. No, you should not want to go into business with me if these are the guidelines. Step 5, risk. Don't lose a lifetime of work because of risk. These are our potential risks when it comes to our money, when it comes to living, taxes, market. We can see it now more than ever. No one knows what the market's going to do. We need to be sure about our money growing. Having a fixed rate, exactly knowing when we're paying our debt off, exactly knowing what our dollars will be each and every month going forward is more important than ever. Inflation. Again, the government is lending and giving out so much money. All signs point to inflation rising. Emergencies. Again, right now more than ever, we see the importance of having an emergency fund. Disability. If you can't work, what are we going to be doing? Protecting against creditors, lawsuits, having fraud protection, making sure we don't outlive our money, and God forbid what happens if we die, what's going to happen to our heirs. Our planning makes sure to address every single one of these risks. When we speak with you on a one-on-one basis, we'll see which ones are most important to you, but in some fashion, our planning will address every single one of these risks for every single person. Step 6, the big picture. Know where you are going and how you're going to get there. Let's think of the 3 phases of money. We need to maximize the efficiencies of our dollars. The less we're giving out, the more we're keeping for ourselves. Understand the flow of your money. Understand where your dollars are going so you can keep more of what you earn. Create that accumulation. Grow your money. When you need it, you can have proper distribution. We will make sure everyone understands these phases, which phase they are in for themselves, and how we can make sure all 3 phases are maximized. Now let's talk about the big picture benefits. What we're going to do for each and every person, and especially couples, especially right now, show them how to argue less about money. How we're going to do that is find wasted or inefficient dollars being spent. By eliminating debt, those payments will be gone and now our cash flow will increase. By stopping paying debt, starting to save it, our savings increases. We will show you how to get out of debt faster than you ever thought possible, plain and simple. Show you how to prioritize your accounts, and down the road, retire with tax-favored income, all in one plan. Let's remember, Mark and Joyce, they had $180,000 in debt. Their interest was scheduled to be almost $200,000, paying on that debt for 30 years. We get Mark and Joyce out of debt in 7.8 years. We save them over $122,000 in scheduled interest payments. Now we've freed up $2,177 a month that before was going to debt, now can come back to themselves for retirement. And in 30 years, not only did they get out of debt in 7.8, save that $122,000 in scheduled interest, but they'll have over $1 million for their retirement. Now, when we go through this, most people see it and they want to understand how they can be just like Mark and Joyce. If you are wanting to see your personalized plan, you'll see our contact information at the end. reach out. We will do a free debt management analysis for you. What we can show you for sure, whether we become a working relationship or not, is exactly how long it will take you to the day and month to pay your debt off the way you're currently doing it. We'll show you exactly how much you're currently on pace to spend in scheduled interest to the dollar. Whether we become in a working relationship or not, we'll provide that information for you complimentary. Then we'll try to analyze your situation and put together a plan and show you how to redirect inefficient spending to eliminate that debt. And if we can do that, how long our way to the month and day it'll take you to get out of debt, and how much money will save you. So let's review. Step 1, knowledge. We're giving you the knowledge, but only applied knowledge is power. We're going to improve your cash flow by using our data gathering sheet, which we can email over to you. Then we're going to put together the report and show you how to reduce debt and build assets at the same time. Again, that report is fully complimentary. Show you how to reduce your taxes while minimizing your risk and have all those big picture benefits. But step 7. Step 7 is your decision, because a goal without a plan is just a wish. What we do in these times will dictate our future. We have to understand now is the time to take action. If we wait, we don't know what situation we'll be in a few months. But if we can take action now, we can change our outcome in the future. Again, the next steps, we can send you over the data gathering forms. By filling it out and sending it back, we'll analyze that data, run your numbers, and schedule a one-on-one consultation to go through your report. Once we do that, you'll have the roadmap to how we can get out of debt together. Again, all that planning is no cost, so please take advantage. To contact us directly, again, my name is David Linsky. I'm the president of Debt Free Living. Our phone number is going to be 1-800-836-1509. That's 1-800-836-1509. You can email me directly at davidlinsky@wehatedebt.com. Check out our website at www.wehatedebt.com. Also, we'll be posting a link to our calendar. Feel free to click on it. Choose a date and time that works best with you. We'll schedule it, and we'll have our free one-on-one consultation. I hope everyone found this to be informative, and I hope it inspires you to take the next step and schedule a free phone consultation. Again, my name is David Linsky. I'm the president of Debt Free Living, and I hope everyone listening is staying safe. I look forward to speaking with each and every one of you on a more intimate basis. Thank you.